Hello, welcome back to the Instech podcast. Zoya, podcast producer here. This week, Matthew is joined by Adrian Coupland at Earnix, a company that's redefining how insurers leverage analytics for pricing, underwriting, and personalization. Earnix recently published their latest report, An Industry at Crossroads. The report draws insights from over 400 global insurance executives and reveals key trends, including the growing focus on modernisation, regulatory compliance, and real-time data adoption. In this episode, Matthew and Adrian dive into the findings, including why 48% of insurers are still lagging in their use of analytics, or how legacy systems are slowing down underwriting rule changes. If you're looking for actionable insights on how to stay ahead in a fast-evolving market, this episode is for you. Now let's dive into the conversation.
Hey, great to have you back. We spoke February 2024. That was episode 288. I think when I spoke to you afterwards, you had a couple of people contact you after that, but great to know any kind of success stories from last time we spoke.
Yeah, thank you. Yeah, it was a great session. Really enjoyed it. Solid feedback. We had multiple inbounds from various people in the industry wanting to know more about Earnix, what we were thinking, what we're seeing in the market, and pick up on some of the key themes from the previous podcast. So yeah, very successful.
Brilliant. We are back and we've got to deliver again next time. Well, we've got something really fascinating to talk about. But just a reminder of who Earnix is. And I don't know if you've seen this, Aid, but we've now got our digital intern that's been listening to everything we're doing, would have been listening to that podcast, and is now helpfully, through the powers of LLMs and generative AI, creating a summary. So this is what it came up with. Earnix is a software provider that offers analytical solutions for rating, pricing, and personalization to global insurers and banks. Your services span various lines of insurance, including personal, commercial, usage-based, and health insurance, enabling more accurate pricing and tailored customer experiences. How do they do with that summary?
Oh, that's very good. Yeah, it's very accurate indeed. I think we can add underwriting capability to our latest part of our product suite. So yeah, but very good. A good starting point.
You've already done that, because the beauty of having a digital intern is they will now be listening to this podcast and will be automatically updating their summary. So we're about 11 months away from when we last spoke. What's been happening in that time with you at Earnix?
It's been an incredible time. We're succeeding very well in the market. We've successfully onboarded a number of new clients across Europe. We've seen some really good traction in the UK market. Clients seem very, very happy, and we're continuing to scale. So 24 is looking like another very good, strong year for us.
We're here to talk about the report you as Earnix have produced, An Industry at a Crossroads, what insurers can do to get a valuable head start and gain a new competitive advantage. And thanks for my preview version of that. I mean, really impressive number of people you got to contribute to that. 381 carriers that had less than 20,000 employees, carriers, of course, being insurance companies, and then another 50 executives where they had more than 20,000. So clearly a very good representation. One question, so we've got some time to talk about the full report, but what are the key themes that stood out for you from that we should be digging into for today?
Yeah, so it covered a vast sort of area of the market. And, the reason we do these industry surveys is because the key part of the ethos of Earnix is the markets and the industries that we're in. We invest in them, and we want to properly understand them. Something we run on an annual basis. Lots of key themes, modernisation, competition, regulation and compliance, all the things that you'd expect to see on there in terms of areas of focus and areas of concern for insurers as, the market gets harder, regulation grows, customer expectation grows, and it's independent, right? So what you're reading in the report is what the contributors have put. It's not something that Earnix has authored.
Good, yeah, because there were a number of themes in there, but the ones we're going to pick up on: modernising. There's one. Second one you mentioned, regulatory and compliance, and thirdly, competition. One of the things that stood out for me when I was looking at that, there was a comment in there that today 52% of insurers use analytics to validate operational decisions across many different departments, processes, and lines of business. Well, that sounds okay, but then the question is, well, why only 52%? What on earth are the other 48% doing if they're not using analytics in their core businesses? So yeah, great to know what the takeaways were, and how does that compare to where we were 12 months ago?
Yeah, absolutely. I mean, good to see the numbers. I mean, 52%, it's more than half, which is always a good indication. There's clear evidence of increased adoption, which is excellent. I think with all things AI, data analytics, machine learning, there's always the desire and the aspiration for insurance businesses to capitalize and move on these things quickly. But there is always the consideration around regulation and, ensuring that what they are doing is compliant, fair, and adheres to the regulatory requirements in the industry and also in the markets they operate in. A good example of that would be, it's quite simple for an insurer to take a machine learning model, see the benefits from it, but then actually getting it into production in a way where if it's influencing the pricing which is being charged to a client, or a client is getting a different price as a result of a machine learning model, being able to explain that to a regulator and then actually explaining to the client is a key issue and a key challenge. And I think that leads into some of the adoption levels. I think the highest area of focus in that survey was that insurers are very occupied on modernization, making sure that they have the right technology stack. And we're seeing a very clear shift in the market where insurers are rapidly trying to move away from monolithic technology solutions where they have everything under one place and moving much more towards an ecosystem where they have best in breed. If they don't, they're always going to stick things on tactically. They're not going to necessarily have the right level of regulatory compliance, the right level of control, and the auditability and visibility that both their clients and the regulators are going to require from them.
And that point about the regulation and auditability, clearly very important. There's a podcast I did a couple of weeks ago with Bob Pick, who's the CIO from Tokyo Marine, and the way he describes the distinction, I think people don't always think about it this way or understand the distinction between AI and generative AI is with traditional AI, machine learning, you should be able to audit the analytics that have been done when you come up with a decision. But generative AI, it doesn't operate that way, so you can get a different answer each time. Is that a theme you sort of see coming through, not just about the impact of this sort of traditional AI, machine learning, but actually now that whole layer of sort of potential issues related to using generative AI on the regulatory side?
Yeah, for sure. I think there's a lot of work to be done in terms of ensuring that, the end results are good, they're natural, they're wholesome, and they're creating the right outcome for everybody involved from a consumer perspective, from the insurance company perspective, and then making sure the regulator's comfortable with what they're seeing out there in the marketplace. But yeah, I would concur with what Bob said. He's a good guy. We know Bob very well.
Good. Well, so I'm going to move on to speed, not something that people always associate with insurance, but it's good to see that 70% of respondents reported they planned on deploying AI models that can make predictions based on real-time data. We know about real-time data from telematics, but we know that there's reasons why that doesn't always work so well for insurers. But can you just sort of talk a little bit more about what people are thinking about, where they want to be using that real-time data?
I guess what we're seeing more and more is, there's more and more data being created every day. More and more insurers are wanting to capitalize on that data to make sure that they are, providing the very best pricing, the very best product selection for their clients. And we're seeing insurers really getting far more in tune from the perspective of understanding how they are trading in a real-time basis. So the market is becoming more competitive. There's more and more shifts around, we've seen, certainly not in the last few months, but, over the last year, maybe 2 years, significant increases in things like inflationary rates, and insurers then trying to capitalize and understand, the impact on inflation to their supply chain from a claims management perspective, and then the impact in terms of their loss ratio. How do they affect change quickly and rapidly in the pricing area to make sure that they're pricing effectively, taking into account, shifts and changes in the supply chain. So that would be an example of, insurers and their need and their requirement to take, data and then update their pricing in a far more rapid way. But then even away from, maybe some of the longer tail impacts of inflationary rates and inflationary changes, actually insurers being able to monitor how their products are performing in real time. So they've, designed something, they've tested it, they've put it to market, being able to assess in real time whether those products are performing accurately and effectively against their predetermined KPIs. Are they converting the right level? Are they selecting the right risks? Have they got the right level of risk selection and the right risks being written into their portfolio? And if they're not, can they modify that in flight and make sure that they are taking action in real time to ensure that they've got a balanced portfolio of business that they're writing, rather than getting to the end of the week and going, we've underwritten too many of these, we now want to sort of turn the dial down. We're seeing a lot more interest from insurers to actually look at real-time trading data and actually affect pricing change and risk selection change much more quickly, so they can ensure that they've got a much more profitable portfolio. Yeah,
that's actually a really helpful distinction, because and I sort of just took one perspective on real-time data, which is more about risk data. But I mean, the way you're describing it is true of any business, and often it's really being able to get access to data from your own organization, which one level, which is your point about what's happening, what's profitable, but also to your point about there's an enormous amount of data available free now, APIs on inflation data and actually transaction data and real-time data coming in the external environment that can be used for pricing. So it's not necessarily about having to get your client's data and go through all the challenges of trying to get that. But your point is there's more information available that just makes you make better decisions, not necessarily involving the client at all, but just the basic economic background. And then the other encouraging one on here was that we see just sort of because you do this year to year, although I still think it's quite a long time, 79% of respondents this year claim they can implement an underwriting rule change in 5 to 6 months or less. Whereas in 2022, you find that only 62%. Well, it's great to know it's improving, but that still seems an awful long time, 6 months, to actually make a rule change for underwriting. What's happening here? I mean, clearly there's got to think quite carefully about doing that, but that still seems quite a long time to change a rule.
It does, yeah. And I think the delay and the slowness, if that's the right way of describing it, of these changes and actually getting them deployed to market is very much a symptom of legacy technology as much as anything else. So if I look at what, we do within Earnix and, what we've done to the overall pricing ecosystem over the last 20 years of working with insurers. A key part of that is we've externalized the analytics, we've externalized the pricing, and we've externalized the rating away from these policy administration systems and put them into an environment where the business can actually affect change. They can do the analysis, they can check the analysis, they can sign it off and deploy rate changes to market really, really quickly. And that's now, I think, relatively normalized. I think there's still very mixed penetration across the market in terms of the number of insurers that have actually bitten that off and, done a really good job of analytics through to pricing deployment. And then if you move into the next stage, sort of, I think where pricing started and where underwriting is now is quite similar. So I think insurers are starting to, work through that process of, okay, so if we want to affect change in our underwriting, we want to change an underwriting rule. They're facing very similar challenges to what they were facing 6-7 years ago in the pricing world, which is they've got a desire, they want to make a change. There might be, a new peril, or they might want to, stop writing property business in a certain postcode district due to, adverse weather or adverse criminal activity or something like that. They have to go to the IT team and say, hey, we want to change this underwriting rule. And then fundamentally the delay comes in that process of, okay, so how important is it? How quickly can we get it done? Where does it sit in the change cycle? Does it sit in a freeze stage? And therefore, to me, 6 months, great, is an improvement, but fundamentally, insurers need to be in a place where they can be deploying underwriting rule changes really the same day. They should be able to do the analysis. They should be able to do the analysis, test the outcome, and then deploy just as quickly. Because I think, if you've got great pricing, that's clearly better than not having great pricing. But if you've got great pricing, but you then don't have great underwriting, you're not getting the full benefits of, underwriting and pricing combined together. And really, they need to be moving at a very similar pace.
And presumably that's what you're doing with Earnix. I mean, your point, the barriers to change these days are increasingly less technical. Certainly people use modern systems, contemporary systems. So notwithstanding, they need to kind of work out their own sign-off process. But presumably if you've got a more agile system that people are using, then you don't need to get IT to make a change. You can do that yourself or as a business user. Presumably that's how you're helping sort of solve that problem.
Yeah, very much so, very much so. And I guess the important bit is you're empowering the business users, you're empowering the business to get on and get these things done, but you're delivering it in a very compliant and regulatory manner. So there's no way that, rogue rules are going to get out there without, the right level of sign-off process being achieved across the organization. And, great visibility, great auditability, and great traceability. So any rule that gets deployed, whether it's a pricing rule or an underwriting rule, can never get deleted. You can always track back to it. So if the regulator comes knocking 18 months later and says, tell me why you made this underwriting decision, or tell me why you made that pricing decision, you've got full auditability, which is super important.
And then barriers to improvement. So you touched on this a little bit, but 71% of survey respondents said that their current system is either complex or extremely complex. I guess system could be technology, or it just could be the sign-off process, with hundreds or even thousands of rules in place. I suppose one question I sort of had for you on that, related to that, was thinking back again about Earnix. What's been intriguing talking to people with new technology is you're not only doing what we just talked about, which is trying to enable the business users to use the technology day to day, but the whole way that you can get in front of the buyer. People are now finding quite clever ways of, for example, you can do proof of concepts, test runs, even use a little bit with a credit card and test the system before committing. Are you, as with Earnix, I mean, for people that want to test out Earnix and don't necessarily want to have to go through a whole procurement process and IT, is there a kind of fast track way they can at least get some more visibility themselves?
Yeah, very much so. We with every new client that we onboard, we always run through a proof of value or an evaluation of the software, where we will essentially work very closely with the client to understand, what are their use cases, where are their challenges, what they're looking to do, and what do they need to improve. So we'll understand that. Then we will essentially create an environment for them. We'll train them on the software, get them using it, getting them proficient in it. And then they can run it for a period of time to understand, what does the return on investment look like? How much improvement can they be making from an underlying pricing perspective, as well as then, fully understanding, I guess you've got technical improvements in terms of what you're doing from a pricing perspective, but then you've got business improvements in terms of removing any delays or any blockages in terms of the deployment method. So typically an evaluation for a client looking to take Earnix would be 4 to 5 weeks, something like that. And by the end of it, they'll fully understand how the software is going to help them, how it's going to benefit their organization. But then within that process, we understand, what does the implementation look like and, which teams need to be involved in it. So they've got a very good level of visibility, and there's great transparency in terms of, the cost of adoption and then also the cost of run.
Another question in terms of the profile of the people you're working with. So you've been with Earnix for a few years and the industry sort of longer than that. You must be seeing quite a big shift in terms of people's own understanding and personal awareness of technology, not just relying on their IT department, but I mean, in particular, in the last 2 years, people have become familiar with generative AI. But before that, people now are all using mobile devices. That must be helping as well, is it? When you've got a sort of more technology, not just technology astute, but actually people that want to use better technology in the working environment. In some cases, they're choosing who they go and work for on the basis of the systems those companies are actually committing to and investing in.
Yeah, for sure. You're absolutely right. I think maybe 7-8 years ago, there's almost like a gap between technology buyers and what they experienced in their own personal life versus what they were experiencing in their business life. And I think that gap has dropped quite dramatically in terms of generally the expectation for buyers, but also consumers, which I think is driving a lot of this, is consumers expect better service. Consumers expect good service, good price, good responsiveness. And therefore that puts, a significant area of focus and responsibility on service providers to make sure they can service their clients, because clients will, if they don't get the right price, they don't get the right service, they will vote with their feet and go and find a provider that does look after them. So I think that that, as well as the fact that there's more choice out there, there's a better view of what good looks like in terms of move away from monolithic into ecosystems. Combination of all those factors are bringing together a position where the buyers are much more informed. They're much more seasoned and much more aware of what they actually want to be taking into their organization. We're seeing the buying committees get much, much bigger as well within our target organizations. It's in the double digit rather than single digit on these on most of the engagements with clients now. It is far more parts of the organization are being involved, brought in, have got a point of view and and an investment in where the organization is going from a technology perspective.
I was nodding along happily to all those great things, and then you said the buying committee's got double figures. And I was thinking it's a bit of a double-edged sword. That, I mean, it's great to get more input, but of course, it must also make it harder to progress. Or do you find actually sometimes that can actually be helpful, just because you kind of get everybody's support for it?
Yeah, I think it was a transitionary point. I think it's now sort of just expected as a result of, there's more stakeholders, there's more people with a vested interest. And I think if you work on the basis that you need to get their sign off early, their investment early, and their buy-in early, then it actually makes the process quite a bit easier. I guess you get less crosswinds further into the flight if you've got it all sort of buttoned down in the early days.
Yeah, I mean, it just reminds me of my early days and I was selling technology and learning that you can get lots and lots of people that can say no, but you often only get one person, the economic buyer, that can say yes. And so, being able to satisfy all the people that can say no is pretty important. And then finally, as a back on the report, so compliance. So 2/3 of the respondents reported they're either going to spend slightly more time or significantly more time on regulatory compliance next year as compared to this year. Does it impact what you're doing at Earnix and just generally what's happening there?
I think I'll go as far as to say I love compliance from the perspective that it's sort of is an ever existing position within the market. I think compliance is great. I think regulation is great, as long as it's delivered in a way which is creating good outcomes for clients and is creating good outcomes for the industry rather than just creating an overhead. To me, from a compliance perspective, I think it speaks volumes to what we do. You know, we take our responsibility as a technology provider into the insurance industry very, very seriously. You know, we make sure that everything that we do is compliant. We make sure that there's great visibility, auditability, so that, you know, our clients they can trust Earnix to look after them, and they can trust the Earnix solution to make sure that it's giving good outcomes for them and for their clients in the marketplace. The regulatory backdrop and the compliance backdrop is only going to continue to grow. It's not going to get less. I think, you know, as the market gets more complicated, as more data comes in, as more technology comes in, the regulatory burden and the compliance burden will continue to grow. I think of it as a world of, if you can get the policy administration solutions into a place where they're fundamentally a system of record, and then, you know, all of the core capability, whether it's claims management, whether it's accounts, CRM, pricing, rating and underwriting, are externalized, I think that makes the market more agile, and I think it will create a better outcome for the end consumer and also the insurance industry.
Yeah, like I'm also a big fan of regulation done in the right kind of way, and I feel regulation is one of the biggest drivers of innovation, because almost every other reason for doing innovation is optional. But when you got to respond to regulatory pressures, then you just have to get better. And often, as you're saying, done well, that actually does drive efficiencies in the process. So I think some might think it's a necessary evil. I think it's actually just a great enabler that we should, to some extent, celebrate, as provided it's done sensibly. And then finally, just as we kind of get close to wrapping up, maybe a word or two for recommendation for insurers that want to stay competitive with their peers about what they should be thinking about as they look at 2025.
I could be as blunt as to say, come and work with Earnix, because it'll help you be far more competitive than against your competitors. I might just leave you with that. But I think always be looking ahead, always be curious. You know, don't think about where the industry is going in 2025. Where's it going to be in 26 and 2027? Because we all know it works in cycles. We go through hard markets, we go through soft markets. Stay curious, stay interested. Select Earnix, I would suggest, is probably the best 3 bits of advice I can give.
I think that's a very fair thing to say, given everything you've done and with the report. And talking about the report, so how should people get hold of that if they want to read it in detail?
Yeah, head to the Earnix website, and there's a link on there. You can download the report and then benefit from all of the great intel in there.
Excellent. And Ed, I've asked you a lot. Is there anything we haven't talked about that we'd just like to add before we wrap up?
No, that's great. No, really enjoyed it. Let's get another one of these booked in for next year. And we'll give you an update middle of 2025 on how things are going and our next office move. Brilliant. Well, have a great new year into 25, and look forward to seeing you face to face again soon. Thanks. Sounds good. Thank you very much. Thank you, Matthew.
Well, if you've made it this far, then I'm pretty sure you found that as interesting as I did. If you haven't already heard, Exponential Risk London is a new 2-day conference hosted by Instech, dedicated to addressing the evolving needs of the global catastrophe and climate modelling community. Tickets are now on sale, and hopefully we'll see you in March. That's all from us this week. Goodbye.